Hello, good evening everyone, and welcome to this week's session. We'll be discussing money management today. Like we said, we're building up to the 2 weeks live trading session. So we're looking at different topics that we'll be using when we start the 2 weeks live trading session. So we're going to be talking about money management today, which is a crucial part of trading, because without good money management, you're going to find it very difficult to succeed as a trader. So money management is one of the crucial M's. As we know, for you to be a successful trader, you need to apply the 3 M's to your trading. The first M is mind, which is trading psychology. That's the first M, mind. Second M is money management, which we'll be talking about today. And the third M is method, which we'll be talking about in subsequent weeks. But you need to apply all the 3 M's for you to become a successful trader. And when we start the 2 weeks live trading session, we'll be applying all 3 M's to our trading. Okay, so what is money management and what is it all about? This article really encompasses all you really need to know about money management. So I'll read this article very slowly, very important article, and as it says here, it's within a good article that's titled "Why It's So Difficult for Most People to Make Money in the Market." It was an article written by Dr. Van Terp in the November 1997 newsletter of the Market Technicians Association. Now, he states that in his article that most of us grew up exposed to an education system that brainwashes us that we need to have 90 or 95%. Sorry, the slide just went haywire for a second. Sorry about that. So he said most of us grew up exposed to an educational system that brainwashes us with the idea that you have to get 94 to 95% correct to be excellent. And if you can't get at least 70% correct, you're a failure. So mistakes are severely punished in the school system by ridicule and poor grades, yet it is only through mistakes that human beings learn. Now, if you contrast that with the real world in which we live in which a .300 hitter in baseball gets paid millions. In fact, in the everyday world, few people are close to perfect, and most of us who do well are probably right less than half the time. Now, the key statement is the last paragraph there, where it says, indeed, people have made millions on trading systems with reliabilities around 40%. That is a key part of that of this slide. So the last statement there is a statement that you should always remember as a trader, that says, indeed, people have made millions of dollars on trading systems with reliabilities around 40%. That is a crucial statement. Now, what that means is that when we say that people have made millions on trading systems are whatever method you're using to trade. So trading systems just encompasses all your strategies, your trading strategies, whatever software you're using, whatever indicator you're using, whatever strategy you're using, whatever type of analysis you're doing, the reliability you're going to get is around 40%. So basically, regardless of what you do as a trader or how you analyze the market, your success rate will be around 40%. And that's a crucial statement, because most people get into trading thinking that they can get 100% success rate. 100% success rate does not exist in trading or in the financial markets. If you think you're ever going to find a trading method or a strategy or a software that is going to give you 100% success rate as a trader, you're living in cloud cuckoo land. It's never ever going to happen. So don't waste your time looking for a perfect system. It just doesn't exist. It does not exist. You can't even get a 90% or 80 or even a 70% success rate. So, but as you can see from the statement, even with a 40% success rate, you can make a lot of money trading the markets. But you now have to remember, if you have a 40% success rate, that means you have a 60% failure rate. So that means that every time you trade, you have a 40% chance of being successful in that trade and a 60% chance of being unsuccessful and losing money on that trade. So basically, every time you trade, you have more chances of losing money than making money. And that's something you should always remember as a trader, that every time you trade, you have more chances of losing money than actually making money. So basically what that tells you as a trader is that you need to be careful how much you're risking per trade. So once you get this into your head as a trader, that there's more chance of you losing money than making money on every trade, then that in itself would force you and remind you to risk what you can afford to lose. So you only risk a small amount of your capital because as the chances are you're going to lose the money. But the sad thing is that most people get into trading thinking that, every trade is going to be successful. They get greedy and then they risk more than they can afford to lose, and they get wiped out in their first or second trades. And that's just because of lack of money management. Because money management tells you that every time you trade, there's more risk of you losing money than making money. So hence, you need to risk just a small part of your capital, risk what you can afford to lose, but because there's a high chance you're actually going to lose that money. The other thing that this money management helps you understand is that trading is not for the risk averse. Because if with the ratios of 40% success rate and 60% failure rate, it means that losses as a trader are inevitable. Losses are inevitable. Whether you like it or not, regardless of the analysis of the market, losses as a trader are inevitable. So if you're risk averse or you're scared of losing money, then trading is not for you, because those losses will come, whether you like it or not. But obviously, once you can accept the losses will come, then it helps you deal better with them when they do come, because you know they're going to come, and most importantly, it will help you manage how much you risk per trade. So that's why that statement is so crucial in you understanding the statement and knowing how to apply it to your trading, that people have made millions on trading systems with reliabilities around 40%. So you only need a 40% success rate to be successful as a trader. Okay? So very, very important. Now the next article I'm going to show you that's also just complements what we've just discussed. So this is another article by Gerard Loeb, and he wrote in The Battle for Investment Survival that the most important single thing I learned is that accepting losses promptly is the first key to success. So if you go over that statement again, there's some key words there. He says the most important single, which is just one, the most important single thing that he learned is that accepting losses, not profits, but accepting losses promptly, not slowly, but promptly, is the first key to success. Not the second, not the third, but the first key to success. And obviously, if you then appreciate what we've just discussed previously about the 40% success rate and accepting that losses are inevitable, then you'll be able to accept losses promptly when they do occur, and they will occur. So I'll just go over that again. Like Gerard Loeb wrote in The Battle for Investment Survival that the most important single thing I learned is that accepting losses promptly is the first key to success. Now Loeb goes on to say that the difference between the investor who year in and year out procures for himself a final net profit and the one who is usually in the red is not entirely a question of superior selection of stocks or superior timing. Rather, it is also a case of knowing how to capitalize your successes and curtail your failures. So basically, as a trader, what you want to do is that when you do have those losses, you want to minimize those losses and make sure you just have a small loss. And then when the market is going in your favor, you then want to capitalize on the successes. So that's basically what you're trying to do as a trader, is to make sure that when you lose a bit. And when the market is going in your way, you capitalize and make more than you lose. Basically, in terms of money management, we always say you always want to make 3 times what you're risking. So we always go with the minimum of the 1 to 3 risk-reward ratio. So if you're risking $1 on every trade, then when your market goes your way, you want to make at least $3. You always want to make 3 times what you're risking. And that's the 1 to 3 risk-to-reward ratio. So what are the money management rules? There are rules to money management. The first rule is that you need to decide you're in the market for the long haul. This is not a, I always say it's not a get-rich-quick scheme. So you need to decide you're in the market for the long haul. So you need to pace yourself. You're not going to become a millionaire overnight. And just keep on risking the minimum you can afford to lose, and gradually build up your capital. Second, you need to learn as much as you can from books, seminars, and experts, but be skeptical. Don't believe all you read or you hear. So you always have to make judgments for yourself as a trader, what is good, what is bad, and only implement what is good to your trading. And don't get greedy and rush to trade, but learn to trade properly by applying the 3 M's, and start small and slowly build up. And develop a method of analyzing the market. So obviously you need to have a method of how you approach the market, how you analyze the market. We spoke about that previously when we discussed the trading plan, and we'll be discussing that again in subsequent weeks when we talk about trading strategies. So you have to have a plan or method of how you analyze the market. And obviously part of your method will be your money management. And obviously be aware traders are usually the weakest link in trading. So usually it's not the plan or the money management that you've written down of what you're going to risk, but it's usually the problem of the trader being disciplined to stick to the plan and apply, the proper money management rules and the proper strategy for their trading. So these are some of the rules that would help you in terms of money management. Pace yourself, it's a long haul. Keep learning, keep improving. Don't get greedy, have a plan, and make sure you stick to the plan and be disciplined as a trader. Those are the key points in your success. So the goals of money management are in the following rank of priority. Your first and most important priority as a trader in money management is long-term survival. You always want to survive to trade the next day. Under no circumstances you blow your entire account and capital in one day. So your first goal as a trader and in money management is long-term survival. You want to live to trade the next day. So you only risk a small amount of your capital so that even if you lose that, you still have enough capital to trade the next day. So that's your ultimate goal, and your first goal as a trader is long-term survival. Your second goal is a steady growth of your capital. So as you steadily minimize your losses and you maximize your profits and you're gradually building up your capital, that's the way to go. So you're trying to make sure you minimize your losses, so you can have a long-term survival, and then you capitalize on your profit, and you find out with time, because you're making more than you're losing, your capital will gradually start to increase, and that's your second goal, is a steady growth of your capital. And obviously, as your capital increases, you can slightly increase the amount of money you risk, because obviously as you increase the amount of money you risk, your profits too will start getting higher, and that's your third priority, is high profits. So this is the proper way you need to go about your money management. So it's first, long-term survival, crucial, that's the most important thing. Leave to trade the next day. Second is steady growth of your capital, and the third is high profits. But unfortunately, when people get into trading, most people get into trading with a greed mentality. They want to make money overnight. They want to make a lot of money straight away. So they go straight for the high profits. So their first priority is high profits, which is the wrong priority to have. And because their first priority is high profits with greed, that leads to rapid loss of capital and short-term survival. So you want to do it the proper way around, which is long-term survival, steady growth of your capital, and high profits. So always remember that winners think, feel, and act differently from losers. So as a trader, you might have to change your personality. If you have a gung-ho personality or a risky personality, person that likes to take too much risks, if you're someone that likes to gamble, then you need to really change your attitude and your personality when you approach the markets as a trader. If you're fearful, if you're scared, if you're anxious, all this sort of mental things that can affect your reasoning and your rationale, they will really hamper your trading. So you really need to find a way to discipline yourself so you can be focused, you can be consistent, and you can be disciplined in terms of following your plan and not being greedy or fearful when it comes to trading. All these are very, very important points. Now, this is an article from the Financial Times in UK. It just shows you the importance of money management. So it shows you here JP Morgan. We all know JP Morgan is a top Wall Street firm. They've been around for a long time. They've got brilliant people working for them who've all been to Ivy League universities. But you can see the bank, suffered, they lost $2 billion in trading. The losses actually ended up being about $5 billion. So it just shows you that even the best of the best, if they don't apply good money management, they can lose a lot of money. So you can see here that there's just lack of money management in this case that cost a loss, risking more than you can afford to lose. So you can see if it can happen to JP Morgan, it can happen to any of you. So very, very important that you apply money management. The market has no respect for anyone. Doesn't matter how big you are, or how big your firm is, or how little you are. If you don't apply the 3 M's and you're not consistently applying them, you will lose a lot of money trading the markets. Okay, so that's very, very important. So we'll just have a look at the spreadsheet and show you how you can actually make money with a 40% success rate. Because that's the next question, how do you make money with a 40% success rate? So like I said earlier, the minimum risk to reward ratio you want to use is 1 to 3. So 1 to 3 just means that if you're risking $1 on every trade, that means that every trade you lose money, you only lose $1. Well, if the market goes your way and you're making money, you want to make at least $3. You always want to make 3 times what you're risking. So if you're risking $10 on every trade, then you're going for a profit of $30. If you're risking $20 on every trade, then when you do make a profit, you want to go for a profit of $60. So you always want to go for 3 times what you're risking. So that's what we mean by the risk to reward ratio of 1 to 3. So if you see the example here where we say, like we said in the presentation, a 40% success rate is very good. So if you have a 40% success rate, it means that 6 out of 10 trades will be losing trades. So if you just go by the probability with a 40% success rate, so it means that 40% of your trades will be successful, but 60% will be unsuccessful. So basically 6 out of 10 trades will be losing trades. Obviously, you don't know which 6 will be losing trades, and that's the key. So if we just use this example we have here, where we assume we have a stop loss of 20 pips and a profit limit of 60 pips. So basically, we're saying that for every trade we place, we're only going to risk 20 pips, and if the market goes in our direction, we will take our profit at 60 pips. So you can see that fits the 1-to-3 risk-to-reward ratio. So let's just assume we're starting with a capital of $500, risking $1 per pip, sticking to one market only. So if we risk 20 pips on each trade, that means every time we lose money, we'll lose $20, and then if the market goes our way, we'll make $60. So we're risking $1 per pip, so if we make 60 pips, we make $60. If we lose 20 pips, we lose $20. So we can see from this example here, if we have 10 consecutive trades, obviously this 10 consecutive trades could be over a whole week or even 2 weeks, all depending on your trading plan. But let's just assume we've had 10 consecutive trades. You can see here the first trade you lose out, you lose 20 pips or $20. Second trade you lost, you also lose $20. The third trade you had a profit, you made $60. The fourth trade you lost out, you lost $20. Fifth trade you made money, so you made $60, and so on and so forth. So you can see after 10 trades you've had 6 losses. 1, 2, 3, 4, 5, 6. 6 losses. But because you limited your losses to $20, so out of those 6 losses, total loss was $120. And since you capitalized on your successes, 1, 2, 3, 4, so only 4 profitable trades out of 10, or 4 times 60, 240. And you can see you ended up with a net profit of $120. So you can see you had a net profit despite a 40% success rate and a 60% failure rate. So you can see that's the key to money management. So it's not the case that on your first trade, you hold $500 and then you go wiped out on your first trade. Or because you're fearful, after 2 consecutive losses, you stop trading and you miss out on a profitable trade because of fear. So you can see how the mind comes into play in terms of trading psychology. So if you're greedy or you're fearful, you can see how it can affect your trading and your money management. And also if you're indisciplined and you don't have a plan, it can also affect your trading and your money management. So that's the key to money management. It's, like I said, it's you making sure you risk what you can afford to lose. Don't be greedy, and also remembering that losses are inevitable in trading. So if you're fearful to trading, like I said, is not for the risk adverse, because unfortunately losses are inevitable when it comes to trading. So that's it on money management. If you have any questions, do click the hand button on your control panel or send the questions through to the question box.